Thinking about retiring overseas but still want to receive the Australian age pension? In my last video, I broke down how your pension rate might change depending on how long you're away and whether you are just traveling or moving permanently. But there is another big question people ask. What about tax? Is the age pension still tax-free? Do you lose tax offsets when you become a non-resident? And could you even be taxed twice by Australia and the country you moved to? That's what this video is all about, how the Australian age pension is taxed when you retire overseas, and what to watch out for so you don't end up with less than you expect. First, is the Australian age pension taxable? Since we are talking about retiring overseas, meaning you'll be away for more than 6 weeks, your pension will already be reduced to the basic rate of age pension and the basic rate of the pension supplement. From a tax perspective, that entire amount is considered taxable income. Now, how much tax you will pay depends on whether you are still considered Australian resident for tax purposes. If you are taxed on your worldwide income, including your Australian age pension. But there is good news. Residents get access to the tax-free threshold, low income tax offset, and the seniors and pensioners tax offset. That means age pensioners have a much higher effective tax-free threshold than the headline $18,200. In both FY25 and FY26, this means if you're a single, you can earn up to $35,813 and pay no tax. If you're part of a couple, you can earn up to $31,888 each and still pay no tax. If the age pension is your only income, you'll be under this threshold and you won't need to lodge a tax return. If you do have other income, whether you need to lodge will depend on the type and amount. The ATO has a simple tool online to help work this out. If you become a non-resident for tax purposes, the tax treatment changes quite a bit. Non-residents don't get the tax-free threshold, the low income tax offset, or the seniors and pensioners tax offset. You're taxed on all Australian sourced income, including the age pension, from the first dollar. The tax rate starts at 30% and goes up progressively as your income increases. If you're moving to a country with no tax treaty with Australia, this is how your age pension will be taxed in Australia. And depending on your host country's local tax rules, it could also be taxed again overseas. Meet John. He is a single pensioner who receives a full age pension after being assessed under both the income and assets tests. The age pension is his only source of income. He is a non-homeowner, rents privately, and qualifies for the maximum rent assistance. As an Australian tax resident, John received $1,361 per fortnight. That includes the maximum basic rate of the age pension of $1,051.30, the maximum pension supplement of $83.60, the energy supplement of $14.10, and the maximum rent assistance of $212. On top of that, he receives a pensioner concession card, which gives him access to cheaper healthcare, medicines, and a range of discounts. Because his income is below the effective tax-free threshold, he doesn't pay any tax, so the full $1,361 is his disposable income. But let's say John decides to retire overseas permanently to a country that doesn't have a tax treaty with Australia. He has more than 35 years of Australian working life residence, so he continues to receive the full basic rate of age pension, that is $1,051.30 per fortnight. But the pension supplement drops to the basic rate, just $29 per fortnight. He loses the energy supplement, rent assistance, and his pensioner concession card is cancelled. This part, how the payment changes, is covered in more detail in my other video, so check that out if you want to understand the rules around portability. On top of the reduced payment, John is now taxed as a non-resident. That means he pays 30% tax from the first dollar. After tax, he's left with around $756 per fortnight. His disposable income has dropped from $1,361 to $756, a difference of over $600 every 2 weeks. John moved overseas hoping the lower cost of living would help his pension stretch further, but now he needs to weigh up whether those savings are enough to make up for the drop in his income along with the loss of Medicare and the other benefits tied to his pensioner concession card. However, those default tax rates can be overwritten if there is a tax treaty between Australia and the country you move to. Currently, Australia has income tax treaties with more than 40 countries. You can find the full list on the Treasury website. This treaty set out how income is taxed when it crosses borders. Specifically, it determines which country has a right to tax your pension. If the treaty gives the taxing right to Australia, then the age pension will be taxed here under non-resident rules. So the 30% rate applies from the first dollar. But under the treaty, your new country will often exempt that income or give you credit for the tax already paid in Australia. This helps avoid being taxed twice on the same pension. On the other hand, if the treaty gives taxing rights to your new country of residence, Australia may not tax the pension at all. Instead, the local tax rules of that country will apply. And in some cases, if your new country doesn't tax foreign pensions, you could end up paying no tax at all on your age pension. As you can see, the way your age pension is taxed overseas isn't always straightforward. It's important to seek advice from a local tax professional who is experienced in international tax rules, as everyone's situation is different. And that brings us to a common question. How do you know if you are still considered an Australian tax resident after moving overseas? You see, it's not just about where you live. It comes down to how the ATO assesses your ties to Australia. Right now, there are 4 main tests the ATO uses to decide if someone is a tax resident: the reside test, the domicile test, the 183-day test, and the superannuation test. But these rules can be quite subjective, especially if your situation isn't clear-cut. For example, if you have been living overseas but still have strong ties to Australia, you might still be seen as an Australian tax resident unless you actively sever those ties. That could include selling your home, closing local accounts, and settling permanently elsewhere. It's worth speaking to a tax advisor with experience in international law. They can assess your situation and sometimes can even help you structure things in your favor. You should also be aware that the government has proposed changes to how Australian tax residency will be determined in the future. This is known as the bright line test. The part that matters most for long-term residents retiring overseas is the 45-day rule. Under the proposal, you need to spend fewer than 45 days in Australia in the current income year and each of the 2 previous years to be treated as a non-resident from the day after departure. For those with families still in Australia, the proposed changes could make it harder to break the Australian tax residency, which might work in some people's favor but not for others, depending on where their income is coming from. But that's just a proposal. No legislation has been introduced yet, and it's unclear if or when it will go ahead. So for now, the safest approach is to rely on the current rules and watch this space. I'll keep you posted when there is news. If you're planning to retire overseas, understanding how your age pension is taxed is just one piece of the puzzle. To see how your pension rate might change depending on how long you're away and your years of residency in Australia, make sure to watch my other video. It breaks down exactly how the rules apply, whether you are planning the move or already living abroad. Thanks for watching. I'll see you over there.